Scott Jr., who also sat on Berkshire's board of directors. Mid-American's talented and entrepreneurial management team impressed Buffett, and he thought investing in Mid-American might make sense at the right price. Buffett was cited in a press release saying, "We buy good companies with outstanding management and good growth potential at a fair price, and we're willing to wait longer than some investors for that potential to be realized. This investment is right in our sweet spot." Buffett did not detail his exact thought process in determining the attractiveness of the Mid-American investment, but there are a few factors that likely weighed into his decision. History as a low-cost operator. In addition to achieving the highest returns available under regulatory frameworks, the low-cost operator could protect and reinforce its competitive position by keeping rates low for its customers. This in turn could gain favor from regulators, allowing additional investment. Deregulation. This opened certain markets to allow customers to buy energy from the producer of their choice. A low-cost operator would have additional opportunities for expansion, aided by its ability to improve the assets it acquired. A strong balance sheet. Mid-America's investment-grade credit rating allowed it to lower its cost of debt and thereby improve its ability to keep costs low for customers. It was a virtuous cycle. Even with the prospect of wider deregulation, Mid-American remained an operator in regulated markets, most notably in the Midwest United States. During 1999, 66% of Mid-America's revenues were generated in regulated electric markets, 25% from regulated gas, and 9% from non-regulated businesses. Energy companies within the regulated markets enjoyed protected returns on capital that were typically in the low double-digit area. For example, Mid-America's Iowa operations were allowed a 12% return on equity. The downside of a regulated return was offset by the ability to invest in large sums of capital. Mid-America offered Berkshire Hathaway a place to direct the substantial excess earnings from its other businesses into long-term projects with a near certain rate of return. At a time when Berkshire was finding little else to do with a growing amount of cash, Mid-American was a fitting solution. One final attribute of Mid-American relates to taxes. Here, Berkshire could benefit in two ways. One was via a consolidated tax return. Berkshire's vast collection of highly profitable operating businesses generated a significant tax bill that could potentially be offset by Mid-America's tax position, which sometimes included tax credits. A standalone energy business might not have the ability to use favorable tax positions immediately if its taxable income was not high enough. The second tax-related attribute of Mid-American was deferred taxes. Mid-American had substantial investments in fixed assets. The acceleration of depreciation allowed for tax purposes resulted in the company paying less tax than the income statement indicated. Mid-America's ability to defer taxes was like the interest-free loan Berkshire created via its holding of appreciated securities. It allowed the company to have a higher effective compounding rate on its equity capital than even the regulated rate of return would suggest. It should be noted that regulators would take these tax advantages into account, which allowed the tax advantage to be passed along to customers. Mid-American's unregulated businesses would benefit from it, however. A regulatory restriction barring simultaneous control of regulated and non-regulated entities required a unique ownership structure for the Mid-American deal. Berkshire paid $1.24 billion for common stock and non-dividend paying convertible preferred stock, giving it a 76% economic interest in Mid-American. See Table 6.19. Its voting interest, however, was just 9.7%. Additionally, Berkshire invested $455 million in an 11% fixed income security and committed to invest another $345 million under the same arrangement. Because of this arrangement, Berkshire reported Mid-American's results on one line on its income statement and balance sheet. Instead of reporting all its sales, expenses, and other costs, Mid-American was carried on the balance sheet in the amount of Berkshire's investment and on the income statement as Berkshire's share of its net income. What were Buffett's financial expectations surrounding the Mid-American acquisition? We cannot know for sure, though the regulated return limits and the 11% fixed income security provided some clues. Using financial information for 1999, the last year Berkshire purchased its ownership interest in the company, Mid-American's pre-tax return on capital was 11%. Was this a coincidence? Perhaps. The analysis was probably much simpler. Mid-American provided Berkshire a platform to invest large sums at low double-digit returns. An added bonus was the tax benefit from joining Berkshire's conglomerate holding structure. Considering its position as a low-cost operator and its monopolistic position in certain markets, the company had a strong likelihood of earning similar returns far into the future. In other words, Mid-American was protected by a moat. 2. Court Business Services. Acquisition date, February 18, 2000. Description: renting furniture to businesses and apartment owners via its 117 showrooms. Purchase price, $386 million. The Court Business Service acquisition began in 1999 but closed in 2000. See Table 6.20. The opportunity materialized after an unfriendly takeover by one of its competitors failed to go through. Buffett liked the fine though unglamorous business, its CEO, Paul Arnold, and the price, established via the failed deal amount. Berkshire purchased Court via Wesco, its 80% owned subsidiary. Wesco's chairman, remember, was Charlie Munger. Munger summed up the deal succinctly in his 2000 letter to Wesco shareholders. Thus, in essence, Wesco paid $386 million for $54.3 million in pre-tax operating earnings. Berkshire paid a premium over the company's underlying capital, but its going-in return was satisfactory at 11%. Additionally, it had the prospect of earning good returns on incremental capital going forward if Court could continue to grow. In short, it appears Wesco and Berkshire acquired a good company for a fair price. 3. U.S. liability. Acquisition date, August 8, 2000. Description: insurance. Purchase price, undisclosed. Half cash, half stock. Augmenting Berkshire's already large slate of insurance businesses, U.S. Investment Corporation, USIC, was the parent company of U.S. Liability, a medium-sized, highly respected writer of unusual risks, wrote Buffett. USIC also came with two smaller sister companies, Mount Vernon Fire and U.S. Underwriters Insurance Company. The deal came about via General Re CEO Ron Ferguson, who introduced Buffett to USIC CEO Bob Berry. Berry's family had owned U.S. Liability for 49 years, though the company was now run by Tom Nerney, a manager Buffett praised for having achieved a rare combination of excellent growth and unusual profitability. 4. Benbridge Jeweler. Acquisition date, July 3, 2000. Description: a 65-store chain of upscale jewelry stores and shopping malls in the West. Purchase price, undisclosed. Half cash, half stock. The Benbridge acquisition had many similarities to other successful Berkshire acquisitions, including expanding a business Berkshire was already in this case jewelry. Being introduced to Berkshire by the homegrown recruitment system, this time Barnett Helzberg, and managers who Buffett admired and trusted to run the business without interference, cousins Ed and John Bridge. Buffett liked the 89-year-old company's truly remarkable record of same-store sales growth over the preceding 7 years. Like Helzberg, Benbridge operated out of multiple locations versus the one-store operation of fellow Berkshire jewelry retailer Borsheim's. Similar to the Taleman brothers of Jordan's Furniture, the Bridges gave some of their sale proceeds to employees. 5. Justin Industries. Acquisition date, August 1, 2000. Description: maker of Western boots and bricks for construction. Purchase price, $570 million. Justin was a somewhat unusual company with its two unrelated business lines, but it was right at home with Berkshire. H.J. Justin started the business in 1879 doing boot repairs. His sons expanded the business to 26 states, Canada, Mexico, and Cuba until 1948, when John Justin Jr. purchased the business from his father and uncles. In 1968, Justin Industries was formed to hold the boot business and a new unrelated sister company, Acme Brick. Justin later added Nakona Boot, Chippewa Shoe Company, and Tony Lama Boots. John Justin Jr. unfortunately passed away in February 2001, shortly after Berkshire acquired it. Justin left two managers in charge, Harold Melton, who ran Acme, and Randy Watson, in charge of Justin Boot. Acme produced over 1 billion bricks a year in 22 plants and accounted for 11.7% of U.S. brick production. Rare for a maker of bricks, Acme had a 75% name recognition rate in Texas compared to 16% for the runner-up. This differential in brand name extended to its dominance in its local market. Because bricks are necessarily a low value per pound item, low cost and very heavy, its natural market was limited to a certain radius around each plant by the economics of shipping heavy items. Acme's brick business was subject to economic cycles, but its local economies of scale and basic necessary business would lead to long-term returns on capital that were satisfactory and protected. It appeared most of the value in Justin Industries resided in Acme Brick. The brick business grew from 52% of revenues in 1995 to 68% by 1999, and over that time acquired for over 100% of pre-tax operating profits. By contrast, the footwear business struggled over the same period. Footwear profits slowly vanished and losses mounted as management tried to compete against brutal competition. It was a familiar story to Berkshire's existing footwear businesses. We can see the relative stability in Justin's financial statements during the 5 years ended in 1999. Its revenues grew just 10% during that period, and it maintained steady margins and returns on capital. If we assume Justin would earn an average of $1.50 of revenues per dollar of invested capital at a pre-tax margin of 9.25%, about its 5-year average, the company-level return would amount to 13.9%. With its purchase price of 1.75 times the company's enterprise value, Berkshire could expect to earn a going-in pre-tax return on invested capital of around 8%, close to its going-in return when it made the acquisition. Looking at the brick business more closely reveals the true margin of safety in the Justin acquisition. As noted above, the business had all the attributes of a moat along with its associated protected returns on capital. While the data is imperfect, it reveals a growing business with solid and stable margins and attractive return on assets. Justin's overall results were dragged down by the low or non-existent profits from footwear, and this hid the true value of the acquisition. 6. Shaw Industries. Acquisition date, January 8, 2001. Description: maker of carpet, rugs, and other floor coverings. Purchase price, $2.3 billion for 87.3% of the company. Flooring is higher tech than bricks, but not much. Shaw had just the kind of attributes Berkshire looked for: a business with a dominant market share, 1/3 of the U.S. flooring market, and increasing profitability in a fundamental business. It was also a business with increasing economies of scale and one with invested family owners. A key feature of the deal was a requirement that Chairman Robert Shaw, President Julian Saul, and their families retain 5% of the company. Shaw was started by Robert Shaw's father in 1946 as the Star Die Company. Julian Saul joined Shaw in 1998 when his family's carpet company, Queen Carpet, was acquired by Shaw Industries. By the time of the Shaw and Queen combination, Shaw had over a quarter of the market share of the U.S. carpet market, and Queen controlled 8%. With $4 billion of revenues, Shaw became Berkshire's largest, by revenues, non-insurance subsidiary. Reflecting on this in his charismatic humor, Buffett told shareholders, "Now if people walk all over us, we won't mind." Buffett said the Shaw deal came about when Robert Shaw, Saul, and an unnamed CEO of a potential suitor for Shaw Industries came to see him about writing an insurance policy. Shaw had a potential merger partner with asbestos liabilities from prior years which it desired to lay off on an insurer. Berkshire was unwilling to assume an open-ended risk and the insurance deal fell through, but the meeting planted the seeds for the acquisition soon after. What did Buffett see in Shaw and what was Berkshire getting for its money? To start, revenues grew 43% between 1995 and 1999. Part of that growth, to be sure, came from acquisitions, including the 1998 acquisition of Queen and from strong housing starts in the U.S. Its pre-tax margin, as adjusted for certain non-recurring items, doubled between 1995 and 1999, and its pre-tax return on capital almost tripled in that same period. These are evidence of the company achieving economies of scale. Shaw's 1999 operating results translated into a return on tangible capital of 36%. If these returns could be sustained, Berkshire would see its going-in pre-tax return continue to grow from a base of 15%. Even if we assume 1999 was a high year and the Shaw's normalized return on capital was its 5-year average of 20%, Berkshire's resulting earnings yield would be 7.8%. In either case, Berkshire's purchase price would be pulled upward over time if the business continued to grow while earning good returns on the capital it employed. 7. Benjamin Moore Paint. Acquisition date, December 8, 2000. Description, paint. Purchase price, $1 billion cash. Benjamin Moore added to the slate of low-tech housing-related companies joining the Berkshire family. The 117-year-old business operated via a system of independent dealers commonly found within hardware stores. The deal came about in July 2000 when a director of the company, Bob Mundheim, who was also general counsel of Solomon, broached the subject of a possible deal with Buffett. Buffett said he liked the business and its management, Richard Rube and Yvonne Dupre. He and Munger made a $1 billion cash offer on the spot. Other financial details of the company were not disclosed. 8. Johns Manville Corporation. Acquisition date, February 27, 2001. Description, manufactures and sells insulation and building products in North America, Europe, and China. Purchase price, $1.8 billion. Johns Manville took a long and winding road to its acquisition by Berkshire. The insulation products manufactured and sold by Johns Manville previously contained asbestos and were subsequently found to have caused many health problems. Litigation led to the company's bankruptcy in 1982. To compensate victims, the bankruptcy court set up a trust for the victims and used a controlling interest in the company as the major asset. The trust now sought a buyer to diversify its holdings. When a leveraged buyout, LBO, firm could not find financing, Berkshire made a quick, all-cash, no-financing, strings-attached offer. Buffett convinced Jerry Henry, John Manville's retiring CEO, to stay in his post. Henry ultimately retired in mid-2004. John Manville's returns on capital were good but cyclical. This is not surprising considering how closely it was tied to a notoriously cycle-prone industry. Between 1993 and 1999, its returns on capital averaged 18%, which included the low of 4% in 1993. The premium Berkshire paid for Johns Manville was double the company's underlying capital. Berkshire could still earn a satisfactory return for itself if Johns Manville continued to average the same results through future business cycles. Insurance. Berkshire's insurance group posted an underwriting loss of $1.6 billion that produced a cost of float of 6.1%. As we will see in a moment, this cost was not as bad as it seemed. Compared to an average 10-year U.S. Treasury rate of around 5.5%, it was higher than Buffett preferred. Apart from the primary group, each of Berkshire's main insurance operating segments posted a pre-tax underwriting loss, and General Re was by far the worst. General Re. General Re posted a $1.25 billion underwriting loss. It represented a cost of float of over 8% on the unit's average float of $15 billion. Pricing mistakes of the past still affected General Re, and it would take time to reprice certain policies. Correcting for those past underwriting mistakes required booking a charge in the current year to cover the adverse loss development of policies written in the past. Progress was being made by top managers Ron Ferguson, Joe Brandon, and Tad Montross to get underwriting discipline under control. In General Re's North American property casualty line, earned premiums rose 19.5% to $3.39 billion, but its underwriting loss grew 7% to $656 million. Despite the year-over-year loss widening, results were considered better because underwriting discipline began producing improvements and because of a large aggregate excess reinsurance contract. This contract was responsible for a large part of the increase in premiums, but also $239 million of the net underwriting loss due to accounting rules. The economics of excess reinsurance contracts is such that a large premium is paid up front and claims are paid, usually, over a long period of time. The result is a large amount of float, which compensates the reinsurer for assuming an expected payout above the premium amount. Such an economic arrangement is not unlike that of a loan. The way the accounting works for these contracts is the premium is booked up front in addition to all future expected losses. The difference, usually a negative number, is booked as an underwriting loss. Berkshire had a total of $482 million of such excess reinsurance losses in 2000, $239 million at Gen Re, the remainder at Berkshire Hathaway Reinsurance Group, or BHRG. This represented over one-third, 34.4%, of the underwriting loss for the year in reinsurance. Given the accounting treatment, Buffett thought it appropriate to adjust these types of contracts when analyzing Berkshire's cost of float. This adjustment changed Berkshire's cost of float to more like 4.5%, said Buffett, better than 6%, but not zero. The other type of reinsurance contract Berkshire wrote, General Re and Berkshire Reinsurance, was retroactive insurance, where accounting and economic treatments were more closely aligned. The economics of retroactive insurance contracts are very similar to an excess contract, with premiums booked up front. However, instead of being booked as an immediate underwriting loss, the difference between the lower premium amount and the higher expected loss is booked as an asset. This asset is then amortized into earnings as an incurred loss expense over time. Both excess reinsurance and retroactive reinsurance were considered good lines of business for Berkshire, even if they were not of the gold standard negative cost type. Buffett welcomed such pain today, gain tomorrow business, so long as the policies were priced appropriately, and he thought it important that shareholders understand the economics and the accounting of such business. Returning to General Re, the notes to the financial statements did not sugarcoat the results in international property casualty. Underwriting results for General Re's international property casualty segment for 2000 remained very bad. It suffered another year of motion picture losses, which added 4 points to the ratio. The only good news was that the aforementioned contract had ended. Berkshire's summary of the carnage in General Re's international property casualty segment. 2000. $416 million loss on $2.48 billion of earned premiums, combined ratio of 117%. Comparison from 1999. $473 million loss on $2.34 billion of earned premiums, combined ratio of 120%. General Re Global Life Health earned just 2.8% more business in 2000, and its underwriting results remained unsatisfactory. On premiums earned of $1.77 billion, the group lost $84 million, a combined ratio of 104.7%. Both General Re Global Life Health and International Property Casualty segments reported an extra quarter earnings in 2000. The 15 months of results, which were not considered to be material to Berkshire's overall results, were done to bring reporting in line with other segments. The two groups had previously been reporting on a one-quarter lag, and in 2000 that lag was corrected. Berkshire Hathaway Reinsurance Group. Buffett heaped well-deserved praise on Berkshire Hathaway Reinsurance Group, BHRG head Ajit Jain. During 2000, volume at Jain's group nearly doubled to $4.7 billion. The growth came mainly from a single $2.44 billion contract that retroactively covered a major UK company, not disclosed. Jain also wrote a contract for the Texas Rangers covering its star, Alex Rodriguez, in case he became permanently disabled. Berkshire covered disability for many sports figures. Another contract covered the payout of $1 billion, $170 million present value, price for Grab.com. The underwriting loss from retroactive reinsurance was $191 million. Like General Re, BHRG wrote excess of loss reinsurance contracts that produced 5-year losses with no offsetting accounting treatment. In 2000, such losses were $154 million, which accounted for the bulk of the $162 million underwriting loss from the group. Its catastrophe business again experienced favorable results and posted a profit of $183 million. BHRG had become a remarkable operation under Jain's leadership. Supporting nearly $5 billion in premium volume was just 2.4 percentage points of overhead, the underwriting expenses line. The rest was 101.3 points of losses and loss expenses. Due to the nature of its business writing a few very large contracts, overhead rates fell to low single digits beginning in 1999 as premiums swelled. Before that, the group's overhead ran closer to 20 points, which was about the same as General Re's rate between 1998 and 2000. Berkshire Hathaway Primary Group. Within the more mundane, but no less exciting from an economic standpoint, primary group, premiums expanded 24% to $325 million, and pre-tax underwriting profits rose 14% to $25 million. The increases were primarily due to the inclusion of U.S. liability. Geico. Geico had the rare off year after many years of very good results. One of the reasons was self-inflicted. Buffett said he was wrong in the enthusiasm he displayed in 1999 about investing heavily in advertising. The law of diminishing returns hit Geico hard. In some cases, the company ran 3 advertisements per hour, with the third most likely having very little effect on new business compared to the first. Additionally, Geico's growing market share meant it had already picked up the low-hanging fruit. Other customers would take longer to convert. Due to these factors, Geico entered a new phase of its operations where growth would be slower. This new phase was already evident in 2000. Geico previously focused on preferred customers or good drivers that were low risk to insure. The non-preferred market was dominated by drivers with blemishes on their driving records, including traffic violations and sometimes driving under the influence, DUI. With the non-preferred business, lapse ratios, where people did not pay their premiums, were higher, meaning fewer renewals. So even though Geico added almost 1.5 million new voluntary policies during the year, its policies in force count grew by only 20% of that amount. The major factor in Geico's underwriting loss was competition. The dominant player in the auto industry in the U.S. was, and still is, State Farm. With 19% of the market, State Farm let its pricing slip and tolerated higher loss ratios. This put pressure on industry rates. Geico played the long game and focused on underwriting profitability. Its higher market share and increased pricing translated into 18% premium growth, but this wasn't sufficient to cover all costs. One poor year and a 6.1% cost of float wasn't enough to tarnish Geico's reputation or its prospects. It still had the low-cost business model and plenty of room to grow and catch up with State Farm. Manufacturing, service, and retailing. Berkshire's financial reporting again shifted to accommodate the newer, larger businesses joining the family. The Buffalo News, the Shoe Group, Dairy Queen, and See's Candies now found themselves lumped together with Berkshire's many smaller businesses in the other business category. This was necessary to make room for a new building products reporting line to accommodate Acme Building Brands, Benjamin Moore, and Johns Manville, when that acquisition closed in 2001. These businesses reported pre-tax earnings of $906 million. That represented strong growth compared to the year before, but included new businesses. A more comparable metric is pre-tax return on capital, which fell 6 percentage points to 20.7%. Buffett was not one to bury problems. In his letter to shareholders, he touched on the Shoe Group, which struggled mightily against foreign competition. Dexter played its part in dragging the Shoe Group's pre-tax operating profit down from $85 million in 1994 to $17 million in 1999, the last year before the group was consolidated into other business. Berkshire now had overwhelming evidence that Dexter was worth less than it paid for the company. As a result, it recorded the $219 million goodwill impairment charge late in 2000. In retrospect, acquiring Dexter was a mistake. A mistake compounded by the fact that Dexter was purchased with Berkshire's shares. Buffett would continually chide himself for underestimating the powerful economic forces at work. We may regain some economic goodwill at Dexter in the future, but we clearly have none at present, Buffett wrote. Other U.S. shoe manufacturers probably shared this sentiment. Earnings from the 2 flight services businesses dipped 5% that year, $213 million, but still represented 13% of Berkshire's consolidated pre-tax operating earnings. Flight Safety, the pilot training business, spent $272 million in simulators during 2000. That figure was far above the $70 million figure Buffett cited at the annual meeting as the company's annual depreciation expense. The larger number represented physical growth of the business. Flight Safety's 83-year-old founder, Al Ultzchi, like Buffett, was not slowing down. Executive Jet's monthly management fees and hourly usage rate fees grew by 49% during the year, which was on top of 46% growth the year before. The business was growing as fast as it could, taking up 7% of the world's output of jets. But building out its business, including the expansion into Europe, was expensive. This weighed on profits and was the reason behind the overall decline in earnings for flight services. With soaring growth, Executive Jet was at the same time careful. Buffett said founder and CEO Rich Santulli insisted on unusually high amounts of pilot training, good news for flight safety. Executive Jet's pilots flew just one aircraft model and received an average of 23 days a year of training, making them among the best. Citing a competitor's crash the year before in Aspen, Colorado, Charlie Munger told shareholders that Executive Jet's pilots had refused to fly into the airport due to weather conditions. The competitor was pressured by its customer to make the landing, which ended in tragedy. Operating profit from Scott Fetzer's 20 non-finance businesses declined 17% to $122 million. The big hitters were Kirby, Campbell Housefield, and World Book, which comprised 60% of its revenues and 65% of its operating profits. Continued struggles at World Book and an unusually strong year at its generator business the year before due to the Y2K scare hurt comparable results in 2000. Buffett devoted a section of his annual report to praise Ralph Shea, who retired at the end of 2000. Since Berkshire purchased Scott Fetzer in 1985, it had sent $1.03 billion to Omaha against a net purchase price of $230 million. Those funds were the seed capital for some of Berkshire's subsequent purchases. He attributed billions of dollars of value to Shea's contributions to Berkshire. Buffett wrote that he and Munger welcomed Shea to the Berkshire Hall of Fame. Finance and financial products. The finance and financial products businesses had quietly grown sizable and received a boost in 1998 with the addition of General Re's finance-related business. At year-end 2000, it had $16.8 billion of assets supported by $1.77 billion of equity capital. It looked very much like a bank leveraged almost 10 times. Such leveraging was ordinary for a bank. Pre-tax earnings jumped from $125 million in 1999 to $530 million in 2000. It housed everything from Scott Fetzer finance arm to the structured settlements and annuities business to General Re's security business, but relatively little was disclosed about it. Shareholders understandably wondered about the unit. At the annual meeting the following year, Buffett reassured shareholders about the relative risk of the unit, though he really did not reveal much. The more basic operations, he said, such as the structured settlements business, were straightforward, quite predictable and very easy business to understand. Moving up the complexity scale, the segment also contained a trading business outside the normal investment category. Buffett described this as arbitrage or semi-arbitrage of various types of fixed income securities. That line of business was run by Mark Byrne, son of longtime Geico manager Jack Byrne, who Buffett and Munger praised as smart and trustworthy. Buffett said the derivatives business within General Re was admittedly outside of their comfort zone, which led them to begin winding down the business. In 2000, Gen Re Securities still had a huge number of derivatives contracts on the books that would take a lot of time and ultimately a lot of red ink to dispose. Investments. Turning to Berkshire's main investments business run by Buffett, with Munger's input, almost all of its Fannie Mae and Freddie Mac shares were sold. The investments were jettisoned after Berkshire's chief capital allocators sensed their risk profiles had changed. They would later be proven right after the companies were found to have overstated their earnings. They would also play a part in the 2008-2009 financial crisis close to a decade later. Poking around the edges, Buffett said Berkshire established 15% positions in several mid-sized companies, bought the high-yield bonds of a few issuers, and added to our holdings of high-grade mortgage-backed securities. There are no bargains among our current holdings. We're content with what we own, but far from excited from it. With little exciting investment news to share, Buffett devoted a couple of pages of his chairman's letter to expanding on the ESOP analogy he first discussed at the prior year's annual meeting. He said investing was as simple as the ESOP proverb that a bird in the hand was worth two in the bush, with one minor qualification. The qualification was when and what was the risk-free rate. If you can answer these three questions, he said, you rank the attractiveness of all possible uses of capital throughout the universe. Those questions were: 1. How certain are you that there are indeed birds, cash, in the bush? 2. When will they emerge and how many will there be? 3. What is the risk-free interest rate? The answers to these questions were the foundation of Berkshire's investment program. It was no coincidence that certainty was placed at the head of the list. Buffett said others had strayed into speculation and forgot to pay attention to this framework. They were instead more concerned about movements in share prices that often traded far ahead of what the fundamentals would suggest was reasonable. Comment by Charlie Munger at the 2001 annual meeting was instructive, as it sheds light on his and Buffett's correct thinking about buying internet companies around the time of the dot-com bubble. He recalled that both he and Buffett had worked at Buffett's grandfather's grocery store in Omaha as youngsters. Munger noted that the business, which included delivering goods to customers, barely supported one family. Buffett made explicit what Munger was referring to. Webvan, an internet-based grocery delivery business, ran into the same cost that Buffett and Son did generations earlier delivering groceries. The internet hype roped many into a speculative frenzy based on the false belief that technology would somehow eliminate cost and shower profits on all. Buffett and Munger looked beneath to the basic economies and saw otherwise. They saw that ordering groceries would go from paper to computer entry, but the cost of buying the product and distributing it to customers would not change. There was a lot of money transferred from the gullible to the promoters of internet stock. It's been a huge trap for the public, Buffett said. Berkshire vs. S&P 500. Though Berkshire beat its preferred benchmark, the S&P 500, by 15.6% in 2000, its book value increased just 6.5%. That was because of a 9.1% decline in the S&P that year. Buffett told shareholders he thought Berkshire's gain in intrinsic value, the metric that really counted, moderately exceeded the gain in book value. With 1999 and 2000 containing pre-tax operating losses before considering investment income, the two-column method, investments per share plus multiples of pre-tax operating earnings per share excluding investment income, for determining Berkshire's intrinsic value became a bit more complicated. See Table 6.27. Buffett even omitted the table in his 2000 annual report. Estimating Berkshire's value required working directly from the financial statements, and it also called for some assumptions on insurance profitability. The first part of this estimate, investments per share, is relatively straightforward. Berkshire's balance sheet provides the amounts for cash and investments excluding the finance businesses. Pre-tax operating earnings is a little more complicated. A quick calculation results in a per-share loss. Capitalizing a loss would lead to a larger negative value, which would reduce the intrinsic value calculation. Yet we know that Buffett would not tolerate large ongoing losses from insurance underwriting, and we know that the operating business had meaningful value. If we make the relatively conservative assumption that insurance underwriting would break even, the per-share operating earnings from the non-insurance business can be capitalized. We can use the same methodology for 1999, which showed a similar pre-tax loss due to insurance underwriting. The change in intrinsic value from 1999 to 2000, using the same method, is 12%, a figure consistent with Buffett's moderately higher change. Berkshire's goal of attaining a 15% average annual rate of return was getting harder year by year, owing to Berkshire's growing size. Buffett told shareholders at the annual meeting that very few large companies would achieve such a record over the next decade. Berkshire would do its best, using opportunity cost as its guide. Buffett summed up the strategy very well at the 2001 annual meeting. I think our method is a pretty good one. I think the idea of having a group of good businesses to throw off cash in aggregate, in a big way, that themselves grow, that are run by terrific people, and then adding on to those sometimes at a slow rate, but every now and then at a good clip, more businesses of the same kind, and not increasing the outstanding shares, I think that's about as good a business model as you can have for a company our size. But what it produces, we'll have to see. There's nothing more to add. 2001. In its race to outpace the S&P 500, Berkshire Hathaway had only fallen short of the benchmark a few times. Those years it at least finished within some sort of increase to book value per share. That changed in 2001 when book value per share declined 6.2% against a decline of 11.9% for the S&P. The string of advances was broken only by a truly terrible catastrophe, the terrorist attacks of September 11, 2001. Like the United States itself, Berkshire was injured but resilient in the face of adversity. Buffett reminded shareholders that relative performance was the name of the game. Berkshire had outperformed the S&P by 5.7%. If you expect, as Charlie Munger, Berkshire's vice president, and I do, that owning the S&P 500 will produce reasonably satisfactory results over time, it follows that, for long-term investors, gaining small advantages annually over that index must prove rewarding. Some disagree with Buffett, but he was stalwart, reminding the shareholders his goal of relative performance would not change. Part of Berkshire's poor performance during 2001 was self-inflicted. Buffett admitted as much. General Re had taken on terrorism-related risks without being properly compensated. Buffett chided himself for knowing General Re was exposed to some of those risks, but he said, "On September 11th, this error caught up with us." On the non-insurance front, Berkshire's businesses were also affected by the attacks and the economy. Buffett thought the country had entered a recession even though economists hadn't announced it. Officials later dated the early 2000s recession between March and November 2001. Still, Berkshire added non-insurance subsidiaries during the year, completing the previously announced Shaw and Johns Manville acquisitions, and closing and initiating several others. The long-term strategy at Berkshire of continually searching for good investment opportunity was unchanged, even in the face of the shock of September 11th. 3 of them are listed below. Mytech. Acquisition date, July 31st, 2001. Description, building products company. Purchase price, $400 million in cash for 90%. Mytech had connector plates for roofing trusses as well as other building-related materials. It also had a proprietary software system it leased to customers. The business came to Buffett's attention the prior year when Gene Toombs, its CEO, sent him a letter along with a hunk of metal, a connector plate. Prior to Berkshire's purchase, Mytech was owned by Rexam plc, a UK company. Mytech was headquartered in Chesterfield, Missouri. The remaining 10% of the company was purchased by 55 of its managers, each of whom put up their own cash to participate. No detailed financial information was available from Mytech because it was part of a group within Rexam. Extra. Acquisition date, September 11th, 2001. Description, trailer leasing business. Purchase price, about $578 million. Buffett said the deal came from his friend Julian Robertson, whose investment fund, Tiger Fund, owned shares in the company. Even though Berkshire's offer contained an out that would have allowed it to back away considering the events of the day, Berkshire completed the acquisition. Extra purchased trailers which were then leased to trucking companies and others moving freight. Its dependence on economic activity made it a cyclical business and therefore like many of Berkshire's other businesses, which overall earned good returns. Owing to the nature of the business, it was placed among the finance and financial products businesses. As a financial-related business, Extra's balance sheet contained a meaningful amount of debt. The company also earned good returns on total capital. Berkshire's purchase price represented a premium of about 60% over the company's underlying equity capital. Considering the purchase from the standpoint of a 100% cash finance business, the effective purchase price yielded 12%. Larson Jewell. Acquisition date, February 8, 2002. Description, manufacturer and distributor of quality custom framing products. Purchase price, approximately $225 million. Continuing to add to its low-tech non-insurance businesses, Berkshire in 2001 agreed to purchase Albeca Incorporated, which conducted business as Larson Jewell. The company serviced a network of 18,000 framing shops in the U.S., and also did business in Canada and Europe. The company was owned by Craig Ponzio, who had worked in manufacturing in college. Ponzio bought the company in 1981 and went on to increase its revenues 100-fold to $300 million. The business was now run by CEO Steve McKenzie. Larson Jewell's economics were very simple. The company serviced many smaller framing shops with very small volumes of business each year. What was important to these shops was a wide selection of inventory available, but without the large carrying costs. With its tens of thousands of customers, Larson Jewell could carry such inventory economically, even though each individual shop might place orders infrequently. This meant 85% of the time Larson Jewell could have an order to a framing shop the next day. This network and a service organization that called on customers half a dozen times a year created a moat around the business. Buffett said the deal came together quickly, having first come to his attention on December 3, 2001. He called it a fat pitch, meaning one which took less than 15 minutes to size up over the phone and 90 minutes to work out in person. Buffett foresaw opportunities for bolt-on acquisitions, small acquisitions by Larsen & Jewell that would fit into its existing operations in the future. Insurance. The main story of 2001 was insurance. The September 11th attacks caused the largest insurance losses in history, and Berkshire took its share. Buffett took the unusual step of issuing a press release on September 12, 2001. He said estimating losses from the terrorist attacks would take a very long time to determine, but he thought Berkshire would incur about 3 to 5% of the industry's losses. In a subsequent unusual move, Buffett included commentary in Berkshire's third-quarter earnings release, which estimated the loss at about $2.275 billion. In that same press release, Buffett chided General Re for breaking all 3 of the rules of operating a successful insurance company. Paraphrasing, those rules were: 1. Only accept risks one is capable of evaluating. 2. Limit aggregated exposure, i.e. diversify risks. 3. Avoid doing business with bad actors. Breaking those rules cost CEO Ron Ferguson his job. Buffett replaced him with Joe Brandon and praised Brandon and his new lieutenant, President Tad Montrose, as talented leaders who would clean up General Re. While Berkshire Hathaway Reinsurance had lost money on September 11th, Buffett noted that unit, led by Ajit Jain, had adhered to all 3 rules of successful underwriting. The insurance group as a unit turned in an underwriting loss of $4.1 billion on $18 billion of earned premiums. Berkshire's cost of float was a staggering 12.8%. That average float grew 19% to $35.5 billion at year-end 2001 was not necessarily a good thing. Remember that a component of float is unpaid losses. Berkshire's float during 2001 grew in large part by incurring losses for which it wasn't compensated. Float at an overall cost in the double digits would not be tolerated for long at Berkshire. General Re. Since Berkshire had purchased General Re in late 1998, the business had cumulatively lost nearly $6.5 billion for underwriting. In fact, in each year since 1998, the losses had only grown. The $3.7 billion loss for 2001 was a terrible underwriting result. Having written coverage for which it wasn't paid, terrorism insurance, General Re lost $1.9 billion from the attacks alone. The segment also took an $800 million loss to correct prior year's underwriting miscalculations. The bulk of the loss at General Re came from its North American property casualty segment, a $2.84 billion loss on $3.97 billion of earned premiums. This was not a case of long-tail contracts or any effective accounting, but simply poor underwriting. A full $1.5 billion of the loss came from September 11th. It was the North American property casualty segment that recorded the $800 million addition to its loss reserves during the year. The international property casualty segment in General Re also experienced very poor results. Some stemmed from September 11th. On earned premiums of $2.4 billion, up slightly from $2.5 billion, the unit lost $746 million. The international segment recorded the net $313 million of September 11th related losses, as well as a $143 million loss from coverage of a steel plant in the UK, which had exploded. An additional blunder at General Re was its Argentinian business, which was in peril owing to an economic and political crisis there. General Re's global life health business continued to be the less dark segment. During 2001, the unit increased premiums 10.4% to $1.99 billion. It reported an underwriting loss of $82 million, including $15 million of September 11th losses. Berkshire Hathaway Reinsurance Group, BHRG. While Ajit Jain's group contained some terrorism-related losses from September 11th, they were not nearly as bad as at General Re. On $2.99 billion of earned premiums, down from $4.7 billion, BHRG reported a $647 million pre-tax underwriting loss. Of that, $530 million, or 82%, was related to September 11th. BHRG's results also included $371 million in losses from retroactive reinsurance contracts, which were the type that came with deferred charges relating to the asset put on the books at inception. While it's possible some of the loss was due to incorrect underwriting, it's more likely the bulk of that $371 million came from accounting charges. Buffett expanded on his thinking regarding the economics of retroactive reinsurance policies at the 2002 annual meeting. It didn't matter, he said, what type of claims they were. Buffett used the example of asbestos versus auto claims. What really mattered was the speed of the claims. Since Berkshire always capped its limits, even if it paid up to the capped limit but over a long period of time, the economics would still be favorable owing to the large amount of float. From purely a financial standpoint, Berkshire's insurance companies, especially the reinsurers, were entities that incurred debt of a slightly different nature. Unlike traditional debt, insurance liabilities had irregular and unknown payments and the possibility of paying less than full face value. Each insurer played an important role in society, which in turn provided the opportunity to generate float. Deferred charges relating to retroactive policies made good performance elsewhere at BHRG. Other catastrophe and non-retroactive reinsurance business earned a profit of $254 million, which partially offset the September 11th losses. With its core catastrophe and non-retro business profitable, Buffett praised Ajit Jain in his letter to shareholders, commenting, "Never on even a single occasion have I seen him break away from our 3 underwriting rules." Jain's team, now with 18 other individuals, would occasionally book a loss, as would be expected, but they would not, Buffett wrote, book foolish losses. While General Re was in restructuring mode under close supervision by Buffett, BHRG used its position as a leader with unparalleled financial strength to write considerable business. Right after the attacks, Jain's group wrote billions of dollars worth of premiums for coverage relating to terrorism, and all risk was retained for Berkshire's account. This time Berkshire was paid appropriately for the risk, and its coverage contained both caps on exposure and exclusions relating to nuclear, chemical, or biological type attacks. These latter exposures were so large that they could conceivably wipe out all the capital in the insurance industry. Therefore, the only natural insurer of such risks was the government. Berkshire Hathaway Primary Group. Berkshire's steady group of direct writers of insurance reported equally steady gains during 2001. On earned premiums of $501 million, the group reported an underwriting profit of $30 million. While they likely had some terrorism-related losses, none were disclosed. Geico. Geico bounced back from its rare off year with a $221 million underwriting gain in 2001, the best performance within the insurance group. Earned premiums rose 8% to $6.1 billion. Its reversal back to a positive underwriting experience was driven primarily from lower losses, which fell 2.9 points to 77% of earned premiums. This was partly due to a mild winter with few accidents. Geico still had difficulty turning advertising dollars into new customers. It spent $219 million on advertising in 2001 while treading water on the new policy front. Its largest share of customers, the preferred group, the segment on which Geico had built its business, represented 81% of policyholders and grew just 1.6%. The non-preferred standard and non-standard group fell by over 10% during the year, resulting in a 0.8% decline in overall policies in force. Geico's float grew 8% to $4.25 billion, despite the overall decline in policies in force, and there were signs soon after year-end pointing to growth in policies in force resuming at Geico. Manufacturing, service, and retailing. Note: in 2001, Berkshire stopped reporting separate financials for the MSR businesses, so data for their collective earnings and return on capital aren't available. Data reappeared in the 2003 Chairman's Letter with an earnings look back to 2002. Rather than attempt to fill in the gaps, we'll proceed with a look at the individual business units. The addition of so many new businesses necessitated another change in grouping Berkshire's results. The building products line, new in 2000, listed just $34 million in pre-tax profit that year. In 2001, it swelled to $461 million as Benjamin Moore, Johns Manville, and Mytech contributed results. Shaw received its own reporting line because of its size. In 2001, it earned $292 million pre-tax on $4 billion of revenues. Revenues declined $100 million, reflecting lower volumes, and were attributed to the September 11th initiated recession in home building. Shortly after year-end 2001, Berkshire acquired the remaining 12.7% of Shaw it did not own. Berkshire paid $4,740 in A-share equivalents, or about $324 million. The September 11th terrorist attacks directly impacted the flight services business. Executive Jet would need to incur additional costs relating to new safety and security rules. There was also a slowdown in fractional jet services usage and a lower level of training at flight safety. Executive Jet had its competitive advantage, which stemmed from its 300-plane fleet of jets available on short notice to ferry customers around the country and Europe. Flight Safety also remained committed to the long term, investing $67 million more than its annual depreciation expense to expand capacity. Retail operations, comprised of the home furnishings and jewelry businesses, earned $175 million, unchanged from the year before. This flat result represented weakness since it included a full year from Benbridge, a small acquisition by Nebraska Furniture Mart, and a new R.C. Willey store in Nevada. Same-store sales from the jewelry business declined 8%. Scott Fetzer managed to increase earnings 6% to $129 million through continued cost discipline. This was even more impressive in the face of continued declines in sales of Kirby units overseas and at World Book generally. Utilities. Perhaps one of the most notable changes, aside from large losses in insurance, was Mid-American. In 2000, Berkshire reported $197 million in pre-tax earnings for Mid-American. In 2001, this figure jumped to $565 million. Why? Two major factors were an increase in operating earnings and the fact that GAAP stopped requiring goodwill amortization, affecting Mid-American to the tune of $94 million in 2000. Finance and financial products. The finance and financial products business again reported strong pre-tax results, $519 million pre-tax versus $530 million a year before. But this was becoming Buffett's show more than ever. The core business of Scott Fetzer's finance arm and the annuity business remained. General Re's securities, like its parent, had fallen from grace. General Re's derivatives business was now in runoff mode. Berkshire was doing its best to get out of the business, but it would take a long time. Investments. As in prior years, Berkshire's investment portfolio changed at a glacial pace in 2001. Buffett's letter to shareholders used such descriptive phrases as few changes, restrained enthusiasm, and lukewarm feelings about the prospects to describe his and Munger's feelings toward investments and the market overall. They were content to hold on to most of what Berkshire already owned, since the long-term prospects for American Express, Coca-Cola, Gillette, Washington Post, and Wells Fargo remained favorable, but they thought their own portfolio in aggregate was not undervalued. Two new investments did join the summary chart in Buffett's letter in 2001, having crossed the $500 million threshold established as a cutoff. Berkshire's nearly 16 million shares in H&R Block Incorporated, a tax preparation service company, had a market value of $715 million at year-end 2001 and cost Berkshire $255 million. While new to the table, Berkshire had owned shares in the company since the last quarter of 2000. Another investment crossing the threshold was Moody's Corporation. Moody's was a credit rating agency that graded companies' debt instruments for investors. Berkshire owned 24 million shares in the company and had first purchased it at the same time as the H&R Block stake. Berkshire put its money where Buffett's mouth was in terms of lower expectations on its investment performance. The expected rate of return on its pension plan was reduced to 6.5% in 2001 from 8.3% that it expected in 2000. This caused a higher expense and a greater liability, all things being equal, since the shortfall between expected returns in the market and cash contributed by Berkshire would widen. Berkshire made a significant fixed income investment in 2001. Early in the year, it committed to be part of a joint venture to loan money on a secured basis to Finova Group. Finova was a troubled finance company that failed. Its prepackaged bankruptcy had been approved in August 2001. While the deal did close, it was not before being terminated and renegotiated. Berkshire chose to terminate the deal based on a clause allowing Berkshire to do so if the markets closed, which they did after the September 11th attacks. Unlike the Extra deal, which contained a similar clause but went unexercised, Finova was materially affected by the event. Finova's assets contained loans relating to aircraft assets that were significantly diminished by September 11th. Its receivables were also affected negatively. The deal called for Berkshire and Leucadia National Corporation to form a joint venture. The joint venture, dubbed Berkadia, purchased the failed company. As part of the deal, Berkadia would borrow $5.6 billion to re-lend, with a 2% spread, to Fanova for its own finance activities. This debt in turn was guaranteed to Berkshire and Leucadia. Berkshire provided a 90% primary guarantee matching its economic interest guarantee. Berkshire provided a 90% primary guarantee matching its economic interest in the loan. Berkadia also received 50% of Fanova's common shares, which were in turn owned 50-50 by the joint venture. True to Berkshire's style, it would be the Leucadia part of the partnership that would manage the investment, not Berkshire. Goodwill. In June 2001, the Financial Accounting Standards Board, FASB, changed the way goodwill was presented in company financial statements. Prior to this change, goodwill was amortized over a period of 40 years. Starting in mid-2001, it would remain on the books forever until and unless it was found to be impaired. Such an impairment was available under the old system as well, and Berkshire had made such a change in 2000 when it wrote off the goodwill associated with Dexter. A consequence of this accounting change was to bring the accounting closer to the economic reality that Berkshire had always considered more appropriate. For years, Buffett had presented his summary of reported earnings table in a way that separated accounting charges from the underlying business results that he and Munger considered most important. The new accounting began in July 2001, affected acquisitions, The new accounting, begun in July 2001, affected acquisitions made after that date. For acquisitions made prior, it would begin in 2002. If the acquisitions Berkshire made during the year were not proof enough of its unwavering long-term optimism, its existing operating subsidiaries were undeterred as well. Buffett pointed to R.C. Willey, which had made an unusual investment in Idaho, and then turned to do the same thing in Las Vegas to much success. Nebraska Furniture Mart began constructing a 450,000 square foot store in Kansas City, which would open in 2003. Berkshire was bruised but not broken by the trying year. Like the country itself, Berkshire learned its lessons and moved forward to strengthen into a better version of the company it was pre-September 11th. 2002. September 11th and the 2001 recession were in the near past, but you wouldn't know it to look at Berkshire's results in 2002. Knowing where and how it aired, Berkshire almost immediately began writing large amounts of reinsurance. Save for General Re, each of the four major parts of the insurance group turned in favorable results. During the year, it completed and initiated billions of dollars of additional investment, and its marketable securities portfolio outdid the market, even though valuations remained elevated. These factors came together to produce a 10% increase in per-share book value, fully 32.1 percentage points higher than the S&P 500. As Buffett put it in the opening sentences of his 2002 letter to shareholders, in all respects, 2002 was a banner year. Insurance. After poor results for 3 years, Berkshire had a 1% cost of float in 2002, compared to 12.8% the prior year. On earned premiums of $19.2 billion, Berkshire posted a pre-tax underwriting loss of $411 million. This result was mostly due to no large catastrophe losses. Float grew by $5.7 billion to end the year at $41.2 billion. The real story, though, was mini-stories, meaning the individual businesses in Berkshire's insurance operating segment. General Re began the process of remolding itself into the reinsurer Buffett had thought he purchased at the outset. Ajit Jain's group at the Berkshire Hathaway Reinsurance Group outdid itself again. Geico shot the lights out, and the primary group had an outstanding year. General Re. With Joe Brandon and Tad Montross now in control at General Re, Buffett thought the company was well-positioned to deliver huge amounts of no-cost float to Berkshire, without the hidden risks of yesteryear. Both Brandon and Montross focused on profitability of underwriting above all else, along the formula of Berkshire's other insurance businesses. The pair increased premium rates on new business, which served to offset the lower volume of business written across General Re's units. Even though General Re's combined ratio came in at 116.4% on $8.5 billion of premiums, a loss of $1.4 billion, the underlying business was transformed in short order. This was evident in its underwriting loss, which fell 62% from 2001. The bulk of the loss stemmed from a $1 billion underwriting loss in the North American property casualty segment, which in turn reflected $990 million of additional loss reserves and followed $800 million in 2001. Continued upward revisions to prior year loss reserves represented real liabilities and clearly frustrated Buffett. The large loss reserve adjustment swamped a $66 million gain attributable to the 2002 accident year and followed a $115 million reduction in reserves related to September 11th, which had been estimated too conservatively. Proving Buffett's hunch that September 11th claims would take a long time to sort out, the North American segment paid out just $241 million of the estimated $1.54 billion net loss attributable to the terrorist attacks. The underlying positives were a nice reversal for General Re, but like all things related to reinsurance, the ultimate results would not be known for years. Berkshire estimated that just 15% of the reinsurance claims in any year were reported the year they occurred. A full 50% of the General Re North American property casualty net loss reserves of $14.9 billion were of the incurred but not reported IBNR category. In other words, future information could move the figure in any direction. The international property casualty segment at General Re turned in an underwriting loss of $319 million on written premiums of $2.65 billion. Premiums grew 10% in dollar terms and were aided by the group's participation in a Lloyd's of London syndicate program, where General Re International took over 90% of written business. Like the North American segment, the international segment recorded a loss to correct prior loss reserves, this time to the tune of $240 million. The group also recorded $107 million in losses relating to floods in storms in Europe. General Re Global Life Health saw its underwriting loss improve to $55 million on earned premiums of $1.89 billion. This was a slight improvement from the $82 million loss on $1.99 billion of earned premiums the year before. Its underwriting results were characterized as poor, reflecting losses from exited lines of business. Berkshire Hathaway Reinsurance Group. Ajit Jain made so much money I don't even want to tell you about it, Buffett quipped at the 2003 annual meeting. BHRG turned in an underwriting gain of $534 million before tax, a dramatic reversal from the previous year's $647 million loss and the most of any insurance division. To do this, BHRG overcame accounting charges and was aided by no major supercat losses. For the first time, the annual report broke down BHRG's subsegments in table form to clearly show its various lines of business. Due to a lack of catastrophes during the year, the catastrophe in the individual risk line turned in a pre-tax underwriting gain of $1 billion on $1.3 billion of premiums earned. The catastrophe segment also benefited from $85 million of reduced reserves relating to the September 11th terrorist attacks. Like General Re, BHRG overestimated its losses and an accounting adjustment corrected for the new estimate. Catastrophe was the type of business prone to large fluctuation in results, but over time was expected to earn a reasonable profit. The profit in 2002 was clearly on the upside. Buffett told shareholders to adjust their assessments of Berkshire's earning power downward because of it. It was not uncommon for reinsurers to lay off their own risk. To do this, they would purchase reinsurance to cover the risk they assumed in reinsuring primary companies. Berkshire Hathaway Reinsurance rarely did this. Berkshire was wary of the ability of collecting on others' promises many years into the future and had seen supposedly strong reinsurers go out of business. Berkshire was willing to take the volatility in periodic results in exchange for better results over the long term, and it had the necessary capital to hold all its volume. The retroactive reinsurance segment of BHRG reported a loss of $446 million on earned premiums of just $407 million. It was this segment of BHRG's operations that had significant accounting peculiarities. Even though the economics were in Berkshire's favor, receiving large premiums up front, followed by, usually, long periods of payments out the door, the accounting caused results to look poor. The premiums earned in 2002 were swamped by $428 million amortized of deferred charges relating to premiums earned in prior years. The favorable economics are illustrated in the $7.5 billion of year-end float from retroactive reinsurance. Berkshire could put this sum to work for its own benefit while concurrently paying claims as they came in. Amortization of the deferred charge asset relating to writing those premiums would remain no matter how much in premiums showed up on the top line. Berkshire estimated that 2003 would see $400 million of such charges from contracts already on the books in 2002. BHRG's quota share business grew almost sixfold in 2002. Quota share business, which was a way of participating in a percentage of the business of another insurer, earned premiums of $1.29 billion and reported a loss of $86 million on that volume. Seeing favorable underwriting conditions, the group participated in a new Lloyd's of London syndicates and booked a contract with a major U.S.-based insurer. BHRG also earned $60 million on $321 million of earned premiums in its other segment. It is worth taking a moment to discuss Lloyd's of London, which has been noted several times. Lloyd's of London was not a single entity, but rather a marketplace for insurance transactions. Insurance could come together to form syndicates or risk-sharing pools. Lloyd's was like a clearinghouse with known rules and ways of conducting business. Berkshire Hathaway Primary Group. The primary lines turned in another year of profit and grew float 38% to $943 million. While most of this segment continued to do well, the workers' compensation business in the home state group suffered. Buffett said its reserving severely missed the mark, placing profitability over growth. He said, "Until we figure out how to get this business right, we will keep it small." Geico. Buffett had a maxim: there are no positive surprises in insurance. This was perhaps off mark with Geico. Geico had another great year in 2002, and Buffett summed it up succinctly. At Geico, everything went so well in 2002 that we should pinch ourselves. Growth was substantial, profits were outstanding, policyholder retention was up, and sales productivity jumped significantly. These trends continued in early 2003. Geico's 10% growth in earned premiums reflected its growth in voluntary auto policies. Its loss ratio also benefited from a mild winter, which edged down 2.9 percentage points to 77% of earned premiums. Its combined ratio came in at 93.8%, a 6.2% pre-tax underwriting margin. Outstanding indeed. Acquisitions. During 2002, Berkshire closed 5 substantial acquisitions in addition to numerous bolt-on acquisitions to operating subsidiaries. 2 of the 5 closed transactions were Albeca, doing business as Larson Jewell and discussed in 2001, and Fruit of the Loom, discussed below. 2 others, with a combined pre-tax profit of $60 million, were CTB and Garon. CTB meant agricultural equipment for the poultry, hog, egg production, and grain industries. Garon manufactured children's apparel and is best known for Garanimals, its largest line. Buffett said each company earned decent returns on capital, but no details were disclosed. Berkshire acquired the Pampered Chef on October 31, 2002, the same day it closed on Garon. Doris Christopher started the Pampered Chef in her basement in 1980 with $3,000 borrowed from her life insurance policy. The company sold kitchenware and equipment at home parties. At the time of Berkshire's purchase, the company was doing $700 million of sales a year through its 67,000 kitchen consultants. Buffett told shareholders it took about 10 seconds for him to decide Berkshire wanted to partner with Christopher and the CEO she had brought in to run the company, Sheila O'Connell Cooper. The purchase price wasn't disclosed. Fruit of the Loom. The well-known underwear maker was the largest low-tech business to find its way onto Berkshire's radar. How Fruit of the Loom became a Berkshire subsidiary was a little out of the ordinary. The company faced bankruptcy after stumbling with operating and financing issues. Berkshire first purchased its bonds and bank debt at 50% of face value, which equated to a 15% current return and amounted to 10% of Fruit of the Loom's senior debt. An unusual feature of the bankruptcy, allowing for interest payments on senior debt during the bankruptcy process, attracted Buffett. The investment was originally intended to be nothing more than junk bond investment, one of very few such outlays during that time. 2 things led to Fruit of the Loom's bankruptcy. First, the company ran up debt of over $1.2 billion. This compared to revenues under $2 billion and falling, and just $130 million of gross profit. Buffett said such metrics pointed to a company that in a financial sense was out of control. A second major issue which both precipitated the debt problem and exacerbated it was bloated costs and other operating issues. Buffett saw the potential for it to regain its status as a low-cost producer of a basic needed product. It had a 40% plus market share in the men's and boys market. Buffett believed the company could once again be a good business once it shed its debt burden and costs were brought back in line. The man to do that job was Fruit of the Loom's former CEO, John Holland, who returned on the scene to fix the mess the prior management team made. It was telling that the only major contingency in Berkshire's offer to the bankruptcy court was that Holland remain as CEO. Berkshire offered the bankruptcy court $835 million, which included the assumption of certain liabilities. Unlike its other deals, the offer to buy Fruit of the Loom came with no strings attached, save for Holland running the company. Neither Berkshire's ability to finance the deal or even more could derail the transaction from closing. Many contracts have what's called force majeure clauses that allow termination for major events such as war or other foreseeable circumstances. The deal closed on April 30th, 2002. It's not entirely clear what sort of financial returns Berkshire could expect from Fruit of the Loom. It appears the purchase price roughly equated to book value. If the rescued Fruit of the Loom could earn returns on capital near what it had during Holland's heyday, Berkshire could likely expect satisfactory returns upwards of 15%. The Fruit of the Loom story has another historical element. During the 1950s, while Buffett was working for Graham Newman, Fruit of the Loom crossed his path. Union Underwear Company, which produced a product under the Fruit of the Loom brand name, had been sold at a mouth-watering price to a company Buffett owned shares in, the Philadelphia and Reading Coal and Iron Company. Philadelphia and Reading purchased Union Underwear, which subsequently purchased control of the Fruit of the Loom brand name and grew pre-tax earnings to over $200 million. Both the 1955 and 2001 deals were assisted by Graham Newman partner Mickey Newman. Mickey was the son of Graham Newman partner Jerome Newman and had assisted Buffett during the 2001 bankruptcy proceedings by sharing his historical knowledge of the company and introducing Buffett to John Holland. Newman attended the 2002 Berkshire annual meeting and received applause from shareholders for his work on their behalf. Another related historical note is appropriate. In December of 2001, H.H. Brown acquired the inventory and trademarks of Acme Boot. Acme had also been purchased by Philadelphia and Reading in 1956. Unlike Fruit of the Loom, Acme had fallen from its former graces. What had been a company worth $7 million in annual revenues was sold for a tenth of that amount in What had been a company worth $7 million in annual revenues was sold for a tenth of that amount in 2001. Berkshire also made two additional acquisitions through Mid-American. Mid-American contracted to buy Northern Natural Gas, a 16,600-mile pipeline supplying gas to Midwestern states. The business was originally headquartered in Omaha. It ultimately ended up with the infamous Enron Company in Texas. Enron's bankruptcy led to the business being held by Dynegy, an Enron creditor that took the pipeline as collateral. It was then quickly sold to Mid-American over the course of a weekend. The other Mid-American purchase in 2002 was Kern River. Kern River was also a pipeline business, this time supplying gas to Southern California. Mid-American now supplied 8% of the gas used in the United States. Berkshire injected additional capital into Mid-American to fund the Northern Natural and Kern River purchases. Remember that Berkshire could not control Mid-American, so its original purchase was structured in such a way to give it a majority economic interest, but a much lower voting interest. To remain a non-controlling shareholder of Mid-American and in compliance with the Public Utilities Company Holding Act, Berkshire purchased an additional $402 million of convertible preferred stock and $1.27 billion of trust preferred securities. As a result of the additional investments, Berkshire's fully diluted economic interest in Mid-American rose to 80.2% at year-end. Interestingly, Mid-American was not just an energy company. It had an accidental business called Home Services, a residential real estate brokerage. Residential real estate and energy were very different, but so were the myriad businesses at Berkshire. Home Services had grown to be the second largest residential broker in the country and did $37 billion of transactions in 2002 alone. This was double its volume just a year earlier. The business was cyclical but had low capital requirements and plenty of room for growth under the leadership of CEO Ron Peltier. Mid-American's pre-tax earnings grew 8% to $613 million, in part due to acquisitions. Manufacturing, service, and retailing. Berkshire's other non-insurance businesses had good results in 2002, especially when considering the recent recession. General weakness in the consumer market prevailed, but Berkshire's jewelry and furniture businesses held their own. Pre-tax earnings in the retail operations segments, which included jewelry and furniture, dropped just 5% to $166 million. Shaw, the newly acquired carpet manufacturer, increased earnings by 45% to $424 million. Just 1% of the increase was attributable to prices, while the rest was because the company judiciously controlled expenses, leading to margin improvement. The chairman's letter grouped Acme Brick, Benjamin Moore and Johns Manville, Mytech, and Shaw into a home and construction-related business category for discussion purposes. As a group, these businesses earned $941 million in 2002. The apparel segment recorded pre-tax profits of $229 million. These weren't comparable to the $33 million loss the year before, since the current year included results from Fruit of the Loom, Guerin, and H.H. Brown. Scott Fetcher's pre-tax earnings were unchanged at $129 million. Results in the flight services segment were worse than they appeared. The reported 21% increase in pre-tax earnings to $225 million included a $60 million gain from exiting a joint venture with Boeing. Operations continued to struggle with post-September 11th challenges that included reduced training, reflecting fewer overall flights, and cost to expand fractional jet service into Europe. Finance and financial products. Within the finance and financial products business category, pre-tax earnings grew from $519 million in 2001 to $1 billion in 2002. Considering that included a $173 million loss related to winding down General Re Securities, contributions from elsewhere were significant. A large part came from Buffett himself, who conducted undisclosed arbitrage-related activities in highly rate-fixed income securities. Another boost came from Berkshire's earnings in its stake in Value Capital, a limited partnership run by former Geico CEO Jack Byrne's son, Mark. Viewed in two broad categories, insurance underwriting and non-insurance businesses, the progress made at Berkshire in 2002 was readily apparent. From an underwriting loss of $2.66 billion after tax and after minority interest in 2001, Berkshire's insurance group improved to a $292 million loss in 2002. On the non-insurance front, earnings jumped from $1.3 billion to $2.2 billion, again after tax, due largely to the addition of several new operating businesses. Berkshire was putting its cash to use productively and returning its core business of insurance to the top of the industry. Investments. Charlie Munger's favorite shareholder meeting group of nothing to add seems appropriate with respect to Berkshire's equity investments in 2002. M&T Bank made the $500 million cutoff to be included in the chairman's letter table for the first time, though it was not a new investment. American Express, Coke, Gillette, and Wells Fargo remained untouched. The only change was in the other category with about $600 million of additional investment at cost. Berkshire's equity portfolio remained concentrated, with 69% of its $28 billion year-end market value in the four returning companies just mentioned above. It seems Berkshire's equity portfolio would remain in a holding pattern for some time. Buffett told shareholders that, unless, however, we see a very high probability of at least a 10% tax return, which translates to 6.5 to 7% after corporate tax, we will sit on the sidelines. Asked about this 10% target at the next year's annual meeting, Buffett said it was nothing scientific, only a somewhat arbitrary point below which it would feel sloppy. He and Munger would rather endure low rates on earned cash than historically low at around 1.25% and wait for opportunities to earn higher rates. While equity markets weren't accommodating, credit markets offered an opportunity for Berkshire to put some of its surplus cash to work at attractive rates of return. A significant decline in the prices of junk bonds began in 2001 and continued into 2002. This improved the risk-reward scenario. As noted earlier, the Fruit of the Loom investment started as a junk bond investment. Berkshire's purchased $8 billion of additional junk bonds in 2002 in various energy and telecommunications companies. One notable purchase was $169 million cost of euro-denominated Amazon.com junk bonds at 57% of par, purchased after the company announced it would expense stock options a practice that was optional at the time. The action gave Buffett confidence in the business and its management. Derivatives. As much as Buffett disliked the accounting of stock options, he thought derivatives as a class represented a true risk to the real economy. Buffett railed against the widespread use of derivatives and their potential to cause unintended harm, devoting 2 pages of his chairman's letter to it. Derivatives, as the word implies, are contracts that derive value from the performance of an underlying entity such as an asset, index, or interest rate. Buffett called them time bombs and saw their potential to aggregate risk rather than disperse it. Once concentrated into a few counterparties, these would then pose systemic risk to the financial system and the broader economy. Derivatives carry dangers that, while not latent, are potentially lethal. In December 2001, Enron's bankruptcy filing shined a light on the dangers of derivatives. Enron had created a market for energy-based derivatives. When the market collapsed, Enron shareholders lost $74 billion. Less than a decade later, their dangers would again be on display during the real estate crisis, in that case due to mortgage-backed securities. The problem was not the efficacy of derivatives to shift risk among parties on a micro level, but their aggregated effects. One entity taking the risk of another at times made sense, such as a manufacturer hedging a key input so that costs are known and fixed prices can be established. The issue arose on a micro level where certain intermediaries collected many of those microtransactions. These intermediaries would then seek to hedge their own risks with the use of still more derivative transactions, thinking themselves protected. This is the type of behavior that General Re Securities undertook, eventually finding itself with over 14,000 contracts with 672 counterparties. Disaster could and did strike when a key counterparty failed or several down the line failed to keep their promises. This could cause a chain reaction that wiped out many once strong institutions. Think of Enron. Another related pernicious effect of derivatives went on accounting and compensation. Buffett and Munger had first-hand knowledge from their time at Solomon and then at General Re of how hard some derivatives were to value. With sometimes thin trading, many derivatives were marked to model, meaning accountants couldn't use market data to establish their value and instead relied on a calculation of value. Oftentimes, these models were constructed by the same people compensated for their results. Accountants, to their shame, sometimes failed to question them. Optimism seeped in, of course, and some contracts had a profit attached to it on both sides of the transaction, which clearly could not be the case. Further, since many contracts spanned years or decades, the results of bad bets would be felt long after the traders who booked them received their own paychecks. Berkshire began winding down General Re's derivatives at the start of 2002, realizing losses in the process. Square's notes. Berkshire issued a first-of-its-kind security during 2002. It was done with the help of Byron Trott, a Goldman Sachs banker who would play an increasingly large role in Berkshire's acquisitions and financing over the coming years. Christened Squares, S-Q-U-A-R-Z, the $400 million issue carried a negative interest rate in exchange for the right to purchase shares in Berkshire at a premium. See Table 6.31. The issue was broken up into $10,000 par value notes in November 2007. Each required the holder to pay Berkshire 3.75% annually for the right to a 3% coupon and the ability to convert the notes into 0.1116 BRK A shares. Thus, Berkshire was paid 0.75% net annually. What did the term of the Squares note say about Berkshire's prospect as judged by each side of the transaction? Those purchasing the notes would benefit only if Berkshire shares increased at a steady clip over the ensuing 5 years, but the rate of return would be lower than the underlying change in share price because of the large upfront premium to both the underlying share price and book value. If the share price declined, holders could elect to receive their cash back at maturity, after paying Berkshire for the privilege. The advantage of the Squares notes lay almost entirely with Berkshire, yet investors nonetheless found them attractive, perhaps due to Berkshire's historical rates of return. Berkshire had the benefit of 1. Upfront use of the cash, 2. Annual interest income from the negative interest rate, 3. Low effective cost if the notes were converted into shares. Buffett was effectively monetizing his modest outlook for Berkshire's future returns. Accounting lessons. Buffett's 2002 chairman's letter purported to be the first to include a negative pro forma adjustment to earnings. He was poking fun at a very serious problem gripping the accounting and business world. Some companies of the day touted adjusted numbers that sought to exclude one-time or non-recurring items. These appeared to make sense on the surface, but over time they served to divert the reader from what was happening. Buffett's jab in his letter was a downward revision, since others adjusted upward without fail, to correct for Berkshire's benefit from no catastrophe losses in 2002 and some outsized gains Buffett booked in the financial products business. His lessons for investors were simple and founded on a base of sound skepticism. Lesson 1 was be wary of companies displaying weak accounting. He used 3 examples. 1. Companies not expensing stock options, which was still optional at the time. 2. Overly optimistic pension assumptions. 3. And companies and managers touting EBITDA, earnings before interest, taxes, depreciation, and amortization. The D in EBITDA, depreciation, particularly bothered Buffett. He said ignoring depreciation was akin to ignoring some other real expense. Just because depreciation was considered non-cash, since no cash went out the door after the initial capital outlay, it was still an expense. Further, it was the worst kind of expense, since money went out the door day one and was only recouped over time as the expense was charged against earnings. He knew from first-hand experience that companies not spending their average depreciation would fall behind in real terms. The second lesson was to be skeptical of unintelligible footnotes. He thought such fuzzy disclosures indicate untrustworthy management. If a reader couldn't understand them, it was probably not their fault, and it could be because the CEO didn't want them to. His third lesson was to have a healthy level of skepticism. It's worth repeating in its entirety. Finally, be suspicious of companies that trumpet earnings projections and growth expectations. Businesses seldom operate in a tranquil, no-surprise environment, and earnings simply don't advance smoothly, except, of course, in the offering books of investment bankers. Charlie and I not only don't know today what our businesses will earn next year, we don't even know what they will earn next quarter. We are suspicious of those CEOs who regularly claim they do know the future, and we become downright incredulous if they consistently reach their declared targets. Managers that always promise to make the numbers will at some point be tempted to make up the numbers. Business results fall where they may, Buffett would always tell the unvarnished truth. Chapter 10, 2003 to 2004. 2003. Berkshire's gain in book value per share fell behind the S&P 500 for the first time in 3 years. While Berkshire's 21% gain was itself highly satisfactory, the 7.7% lag nonetheless represented the 5th time since 1965 that it had fallen short of the market. Part of the reason had to do with the changing nature of the company. Berkshire's fortunes were less tied to its marketable securities portfolio after it completed a slew of acquisitions. A higher proportion of capital invested in operating businesses would cause performance to lag in an up market like 2003, but lead to outperformance during market downturns. Capital allocation decisions and operating performance in 2003 were far from disappointing. On the contrary, Berkshire added important non-insurance subsidiaries to its roster, and the insurance group turned in underwriting profits fit for praise. Insurance. Last year was a standout, wrote Buffett of 2003 insurance group performance. The group turned in an underwriting profit of $1.7 billion, and float grew to a record $44 billion. All 4 of its main insurance segments contributed. Berkshire Hathaway Reinsurance Group continued its tradition of overachieving, General Re was fixed, Geico continued to impress, and Berkshire Hathaway Primary Group remained stellar. Berkshire Hathaway Reinsurance Group. Ajit Jain's group at BHRG again impressed during 2003. Its total underwriting gain of $1 billion on $4.4 billion of earned premiums was in large part due to a lack of catastrophes. The catastrophe and individual risk segment, the segment holding the catastrophe risks, earned $1.1 billion on its $1.3 billion earned premiums for the year. Its maximum probable loss from a single event was $6.7 billion. Such a loss would swamp several years of gains, but its operating philosophy was sound with expectations of modest profits over the long term, catastrophes included. Individual risks also contributed to profits in 2003. Jane's Group found easy bars to step over. One was a Pepsi promotion where Berkshire insured a $1 billion prize. No one won. Such mammoth and unusual risks were bread and butter for BHRG. The retroactive reinsurance segment reported a $387 million loss on $526 million of earned premiums. This was a good result considering amortization of deferred charges hit losses to the tune of $400 million a year, regardless of premium volume. Even with low levels of earned premiums and reported losses, the retroactive reinsurance segment remained a money generator for Berkshire. This segment alone accounted for $7.7 billion of the nearly $14 billion of float attributable to BHRG. Buried in the footnotes in 2003 was an unusual $41 million gain attributed to the BHRG retroactive segment relating to a commutation of contracts written in prior years in exchange for payments of $710 million. What was going on here? While retroactive reinsurance contracts are typically long-term arrangements, they are sometimes prematurely terminated. The $710 million represented a payment by Berkshire to the original ceding company, essentially giving them back some of their original premium. The $41 million was the accounting gain relating to over-reserving expected losses from those contracts. The net effect was a reduction in float for Berkshire as the premium was returned. Other activities at BHRG in 2003 included $2.6 billion of earned premiums and $326 million of underwriting profit on traditional multi-line businesses, with a large part coming from Lloyd's of London syndicates. General Re. The fixers of General Re, CEO Joe Brandon and President Tad Montross, received Buffett's praise for restoring underwriting discipline to Berkshire's problem child. The company was still beset by some unfavorable prior year loss estimates. Nonetheless, General Re managed to eke out a $145 million underwriting gain on $8.2 billion of earned premiums. General Re's North American segment, which recovered its underwriting to a $67 million profit on $3.4 billion of earned premium, improved most. This was up from a staggering loss of $1 billion on $4 billion of earned premiums in 2002. The segment was able to do this via a combination of increased pricing, which was partially responsible for the lower premium volume, and a lack of major catastrophes during 2003. Its current year gains, underwriting attributable to just 2003, were $200 million, but those were offset by $133 million of adjustments relating to prior year losses. Included in those prior year loss adjustments were increases to director and officers' insurance liabilities, resulting from the fallout from the scandals of the early 2000s. Director and officers' insurance provides protection to executives for claims arising from their governments and management of companies. Claims for misconduct in prior years, and the related adjustments insurance companies make to account for them, happen after the fact, since most claims come to light only after a major scandal or bankruptcy. One drag on General Re's North American underwriting results in 2003 was a change to the discount rate used to value workers' compensation claims. Berkshire changed its rate of discount of 4.5% for claims prior to 2003 and began using a 1% rate. This weighted those liabilities closer to the present, which necessitated a $74 million charge in 2003. The international segment of General Re improved similarly in 2003. While premiums earned increased about 6% to $1.9 billion, they only did so as a result of the weakness in the U.S. dollar. Absent such currency-related tailwinds, premium volume declined over 8%. A $20 million pre-tax underwriting gain was a marked improvement from the $319 million loss booked in 2002 and came after a $104 million addition to loss reserves. Berkshire disclosed more details on General Re's activities in the Faraday or London market, which was previously and subsequently included as part of International. General Re participated in 61% of the Faraday Syndicate 435 business in 2001, 97% in 2002, and 100% in 2003. This additional information showed that most losses were outside of Faraday. The segment was responsible for $200 million of losses between 2001 and 2003. inclusive, with $178 million of that coming in 2001, which was just a fraction of the $921 million of pre-tax loss from the segmented international property casualty results over that same time period. The General Re Global Life Health segment reported a $58 million gain in 2003. Most of the gains were in its international business. Geico. Geico had excellent results in 2003, even by its own high standards. Preferred policyholder count grew 8.2%, and non-preferred grew 21.4% for a 10.9% overall growth rate. Premiums grew 16.7% to $7.8 billion on the heels of the unit growth and a 2% average premium rate increase. Such high growth rates necessitated expansion, and in 2003 the company announced an expansion into Buffalo, New York. It was no coincidence that it was in the same city as Berkshire's newspaper, the Buffalo News. Stan Lipsey, the paper's publisher, was instrumental in the expansion, which would eventually add 2,500 new jobs. Even with its ever-increasing need for more employees in space, Geico kept costs down and profits up. Geico boosted advertising during the year and still achieved a combined ratio of 94.2%. Moreover, growth in premiums and policies reflected an increasing market share. From the time CEO Tony Nicely took over in 1992 to 2003, Geico more than doubled its market share from 2.1% to 5%. Berkshire Hathaway Primary Group. The primary group turned in an underwriting profit of $74 million on premiums of $1 billion. Its float grew 41% to $1.3 billion. How could Buffett and Munger be anything but pleased with this group of managers? It seemed every year the group turned in higher premiums, higher profits, and more float. Buffett's comment in his letter to shareholders in 2003 sums up the group nicely. These men, though operating in unexciting ways, produced truly exciting results. Acquisitions. During the year, Berkshire agreed to acquire two companies, Clayton Homes, a leading producer and financer of manufactured homes, and McLean, a distributor of goods to convenience stores and related outlets. Clayton Homes. The Clayton acquisition came about in a most unusual way, even for Berkshire. Buffett long hosted groups of students who flocked to Omaha to hear him speak. On one such visit, he received an autobiography of Clayton founder Jim Clayton from a group of Tennessee students. Buffett had some familiarity with the Tennessee-based Clayton Homes, but he had not studied the company to any great extent. Clayton was a big business. It had 20 manufacturing plants, 300 company-owned stores, over 500 independent retailers, and 89 housing communities. It also had a financial services arm that played an integral role in the company's success. Buffett's newly piqued interest combined with industry turmoil led Berkshire to make an offer for Clayton. Some of Clayton's competitors engaged in poor lending practices to sell homes or make loans to unqualified consumers. Such practices continued longer than they otherwise would have because most loans were securitized. Securitization is a process where many loans are packaged together and sold to investors. Those investors then take on the risk of borrowers defaulting from the manufacturer originators. Once credit problems began to materialize, the ability to securitize dried up and affected Clayton's ability to obtain financing and in turn lend to its own customers. Clayton's board of directors recognized Berkshire's ability to provide financing and agreed to sell to Berkshire. Berkshire paid $1.7 billion for Clayton. The deal closed on August 7, 2003. When Berkshire completed the acquisition of Clayton Homes, it placed its operations in the finance and financial products category. At first, this seems quite odd. That is, until the extent and importance of its financing business becomes apparent. The basic business model worked like this. A manufacturer like Clayton produced a home and marketed it through a distribution channel that could include its own stores or other retailers. Clayton had a mix of both. The home was either purchased for cash or, more likely, with financing provided by an unrelated third party or a financing arm of the manufacturer. Over time, lenders incented to make loans and manufacturers incented to sell homes loosened their standards and began pushing homes and loans on unsuspecting customers with poor credit. To increase their volume of business, the financing was often securitized. The original packages of the loans, incented to produce volume in perspective of repayment capacity, ultimately underwrote many bad loans. The resulting defaults then caused the securitization market to dry up, which affected everyone in the industry, including Clayton. When this happened, Clayton had no way to recoup its cash for additional loans. Berkshire's purchase solved that problem by providing almost unlimited financing to Clayton. Berkshire borrowed money and relent it to Clayton at a 1% spread. But why not just give Clayton the money, since Berkshire had ample cash and it was now entirely owned by Berkshire? Buffett said Berkshire had a philosophy of every tub on its own bottom. He went on to explain, "We believe that any subsidiary lending money should pay an appropriate rate for the funds needed to carry its receivables and should not be subsidized by its parent. Otherwise, having a rich daddy can lead to sloppy decisions." At year-end 2003, Clayton had just over $2 billion of such loans on its books to finance customers' purchases. Clayton's financing arrangements contained two lessons. One, financing interest-bearing receivables with debt is entirely appropriate. It was like a mini bank inside Berkshire that funded its interest-bearing assets with interest-bearing liabilities to take a spread. This was not the first of its kind at Berkshire. Scott Fetzer had a financing subsidiary that financed the purchase of World Book encyclopedias and Kirby vacuum cleaners this way. A second lesson from Clayton's financing was the role of credit risk and incentives. With Clayton under Berkshire's umbrella, it could retain all its loans from its customers. This meant it would ultimately bear the cost of underwriting bad loans and had an incentive to do good by its customers. The securitization model in which the industry previously operated failed in large part because lenders did not care about short-term outcomes. Requiring lenders to keep some of each loan would play a key role in reshaping the U.S. credit system after the Great Recession of 2009, where many subprime loans were resold in packages as mortgage-backed securities. Berkshire's purchase price of $1.7 billion suggests it paid a fair price for Clayton's straightforward business model and its history of consistent financial returns. However, its pre-tax return on capital appears to have been at a low in 2002 as a result of the cyclical nature of its business. Berkshire could see an upside benefit if Clayton could achieve its historical average return of 21%. It could also benefit by providing financing to Clayton and avoid expensive securitized financing. McLean. Berkshire's second major acquisition of 2003 was McLean. McLean came to Buffett's attention via Byron Trott, the Goldman Sachs banker who had worked on the Square's debt issue. McLean was a subsidiary of Walmart that had grown from Walmart's need to distribute products to many stores. The business then expanded to include non-Walmart stores such as convenience stores, drugstores, wholesale clubs, restaurants, and theaters. Not surprisingly, Walmart accounted for 35% of McLean's revenues. McLean conflicted with Walmart's competitors because of its growth, leading Walmart to sell the subsidiary. Berkshire paid Walmart $1.5 billion for McLean, with the transaction closing on May 23, 2003. See Table 6.34. The business was simple and understandable and fit right in with Berkshire's other non-insurance businesses. From an earning power standpoint, McLean's business was not all that unusual. Its profit margins compared to other Berkshire subsidiaries, however, were. McLean was a no-value-add type operation. It simply moved products from one location to another. Consequently, it commanded slim margins, so slim that it earned just 1% pre-tax on a massive $23 billion of revenues. This was a figure greater than all of Berkshire's non-insurance subsidiaries combined. While it was profits, not revenues, that mattered, accounting conventions required that businesses be reported based on their revenues. As a result, McLean would have to remain a separate reporting item in all Berkshire's financial reports going forward. McLean's thin profit margins are a good lesson on the importance of focusing on the right variables in business analysis. Profit margin would seem to be a good indicator of the desirability of a business, and indeed they do carry some important information. As McLean proves, however, a small profit margin can translate into a satisfactory return on capital, provided enough turnover. Non-insurance businesses. As Berkshire's stable of businesses grew in number, it became challenging to report results to shareholders in a useful and intelligible way, or as Buffett put it, without turning out something as long as the World Book. In 2003, the long familiar sources of reported earnings was omitted from the chairman's letter. In its place, Buffett reported on Berkshire's four major operating sectors. 1. Insurance. 2. Regulated utility businesses. 3. Finance and financial products. 4. Manufacturing, service, and retailing. Buffett said his goal was to give shareholders the facts he and Munger would want if roles were reversed, without providing data inessential to calculating Berkshire's intrinsic value. He also cautioned shareholders to be careful in their analysis and to remember that the company should be viewed as an unfolding movie, not as a still photograph. Those who focused in the past on only the snapshot of the day sometimes reached erroneous conclusions. With Berkshire's policy of retaining all its earnings, the reinvestment factor was an important part of the valuation exercise. Regulated utility businesses. Since the insurance group was presented above, we will start with the utility businesses, all under the umbrella of Mid-American. Mid-American's $1.1 billion of earnings before interest and taxes, EBIT, broke down as follows. $289 million, UK utilities, $269 million, Iowa-based utility businesses, $261 million, pipelines, $113 million, home services, $144 million, other income. Mid-America's 2003 EBIT increased 36%, and its net earnings of $416 million were up 9% from the year before. These increases were largely due to the new pipelines funded with additional capital contributions. Mid-America owed $10.3 billion to others and $1.6 billion to Berkshire Hathaway. Including interest income, Berkshire's earnings from Mid-American were $429 million, up from $359 million a year before. Finance and financial products. The finance and financial products segment had the feeling of a drawer of financial odds and ends. All were important businesses and capital allocation activities. Because of the bank-like nature of these activities, they were largely supported by borrowings. One of the largest businesses was trading, which earned $379 million in 2003 and was supported by $7.8 billion of interest-bearing liabilities at year-end. This was an operation managed entirely by Buffett and consisting of a few opportunistic strategies in AAA fixed-income securities. Though far from foolproof, these transactions involve no credit risk and are conducted in exceptionally liquid securities. In other words, an arbitrage operation. The flip side to Buffett's operation was Gen Re Securities, where the derivative business continued to lose money as it wound down. Gen Re Securities lost $99 million pre-tax during 2003, as outstanding contracts shrunk almost 50% from the year before. Such a slow unwinding illustrated a major risk of derivatives. Berkshire was trying to exit during a time of market tranquility. What would happen if markets wouldn't or couldn't work in an orderly fashion? That question would be answered in just a few years. Another investment included in this segment was Berkshire's investment in Value Capital, a fund run by Mark Byrne. Buffett noted that though the fund had close to $20 billion of debt, the operation was sound and Berkshire did not guarantee the debt. At year-end 2003, Berkshire had a net investment of $634 million in Value Capital after receiving a $30 million distribution. The more natural components of this segment were the trailer leasing business, Extra, which was reported under leasing operations, and the life and annuity business. The segment also contained the Berkadia operation, which was nearly completed at year-end 2003. As was noted earlier, Clayton's entire operations were included in the finance and financial products segment due to the size of its financing operation, even though it also manufactured and sold housing units. All told, the finance and financial products segment earned $666 million pre-tax in 2003, compared to $775 million in 2002. These figures were before $1.2 billion and $578 million of pre-tax capital gains in 2003 and 2002, respectively. Manufacturing, service, and retailing. As the years went on, Buffett's sources of reported earnings table had been consolidating certain businesses with others. Home furnishings and jewelry became retail operations. Scott Fetzer's non-finance businesses were reconsolidated back into that category, and the Buffalo News, the Shoe Group, Dairy Queen, and See's Candies were lumped into other businesses. Beginning in 2002, the table disappeared, but the commentary and the annual report footnotes still contain line items for apparel, building products, flight services, McLean, and Shaw Industries. These businesses could be viewed as one sector because of their similarities, though detail was provided for many businesses where needed or important. Each business in the group was closer to a typical business that required working capital, fixed assets, and some limited amounts of debt than the insurance or utility sector. To aid analysis, Buffett now presented a summary balance sheet and earnings statement for the MSR group that was like the supplemental disclosure presented up until 2000. Buffett said the eclectic group, which sells products ranging from dilly bars to B737s, earned $1.3 billion on $32.1 billion of revenues in 2003. The resulting 20.1% return on average tangible net assets, tangible equity, was evidence of their above-average economic characteristics. While we don't have information from 2002 to compare, we know the manufacturing, service, and retailing businesses earned higher returns in the past. In 1994, the first year of the former presentation, after-tax return on equity was 32.4%. Returns dropped to the low 20% range by the late 1990s as Berkshire acquired additional businesses. The new businesses were very good, just not quite as good as the earlier ones. Struggles in footwear and publishing hurt results too. Buffett judged businesses and their operating managers based on returns on capital employed, but Berkshire paid a premium to acquire many of its subsidiaries, and he judged himself based on total purchase price, which included goodwill. Berkshire's after-tax return on carrying value for the MSR businesses was just 9.2% in 2003. Berkshire separated purchase accounting and goodwill accounts to enable shareholders to distinguish the true quality and performance of the businesses and their accounting representation. The building materials business, Acme Brick, Benjamin Moore, and Mytech, earned 21% on tangible net worth. This was quite an impressive statistic for boring businesses. The businesses collectively earned $559 million pre-tax, up 8%, on revenues of $3.8 billion, up 4%, benefiting from strong housing demand. Shaw also benefited from the strong housing market and earned $436 million pre-tax, up 3%, on revenues of $4.7 billion, up 8%. In November, Shaw acquired a related carpet business from Dixie Group, which added $240 million to its revenues. Fruit of the Loom, under the direction of John Holland, returned to profitability and now accounted for 42% of the men's and boys' underwear sold by large retailers. Its women's and girls' share increased to 14%. Two of Berkshire's furniture retailers owned new stores during 2003. R.C. Willey owned a hugely successful store in Las Vegas, which was even more impressive given its closed-on-Sunday policy, and Nebraska Furniture Mart opened a large store in Kansas City, Missouri. Revenues for the retail segment, which included the jewelry businesses, increased 10% to $2.3 billion, but pre-tax earnings remained flat at $165 million due to startup costs for new stores. Flight services continued to experience some turbulence. Combined pre-tax earnings fell 68% to $72 million. Flight safety earned $113 million after writing off $37 million in obsolete simulators. NetJets, Executive Jet now went by this name, lost $41 million as it continued to struggle despite being the dominant player in the fractional jet industry. The NetJets loss included a $32 million loss on aircraft inventory, on top of continued operating losses building out its European business. Buffett remained upbeat on both businesses and noted that both flight safety and NetJets were leaders in their fields. The apparel business continued to struggle. While the additions of the Fruit of the Loom and Garin increased reported pre-tax earnings to $289 million on revenues of $2.1 billion, revenues declined 5% and earnings declined 11% on a comparative basis. Investments. Berkshire's portfolio of equity securities moved just faster than glacial speed in 2003. Buffett reminded shareholders its major positions hadn't changed in a long time. Coca-Cola, 1994, American Express, 1998, Gillette, 1989, Washington Post Company, 1973, and Moody's, 2000. The one exception was Wells Fargo, whose cost basis increased by $157 million. This raised Berkshire's position by 3.2 million shares and brought its ownership interest to about 56.5 million shares and 3.3% of the company. 2 new companies made the $500 million threshold to be included in the chairman's letter: HCA Incorporated, a company that ran hospitals, and PetroChina, an oil and gas company. Berkshire had 15.5 million shares in HCA, representing a 3.1% interest in the company. At year-end 2003, it had 2.3 billion shares in PetroChina, representing a 1.3% interest in the Chinese company. Buffett expressed neutral feelings on the portfolio, both in his letter to shareholders and at the next year's annual meeting. "We are neither enthusiastic nor negative about the portfolio we hold. We own pieces of excellent businesses, all of which had good gains and intrinsic value last year, but their current prices reflect their excellence. While the intrinsic values of these companies increased, so did their share prices. This did not create a price-value discrepancy wide enough to make major changes." Buffett also discussed Berkshire's default position, which was to place any surplus cash in U.S. Treasuries. He said Berkshire would never reach for a little more income by dropping our credit standards or by extending maturities. "Charlie and I detest taking even small risk unless we feel we are being adequately compensated for doing so." Knowing that markets could turn quickly and valuing certainty, Berkshire placed its excess cash in the safest, most liquid securities available. Governance. Berkshire added 4 new board members to its roster in 2003. This brought its total to 11. The 4, all friends of Buffett, were David Gottesman, Charlotte Guyman, Don Keough, and Tom Murphy. Don Keough, a former Coca-Cola executive who now served as chair of Allen & Company, and Tom Murphy of Capital Cities ABC were already known to Berkshire shareholders through Buffett's writings and comments over the years. Buffett had known David Sandy Gottesman for almost as long as he had known Munger. Gottesman had partnered with Buffett